Hello guys, so today we're going to do something that we have intended to do for quite some time, which is recording an entire session talking about how to use the strategy without the indicators. And this is basically a topic that some of you guys have been waiting for quite some time, and we're going to go into much details today to let you know everything that you need to know to do this well. Okay, so basically, whether it is because you are too low capitalized to use the indicators, or if you just simply don't want to use any indicator at all, which I will totally understand, then this video is for you. Alright, so what we're going to be doing today is actually quite simple, is to let you understand that if you want to use the strategy without the indicators, it's totally doable, and it's not that complicated. It's just that it requires a little bit of work to get it settled, so account for this, okay? You can't get started immediately if you intend to use the strategy without the indicators. You're gonna have to read the PDF manual still. You're just going to be able to pass on all of the details concerning the specific indicators, outputs, and so on. But still, you might want to be aware of these. Even if you don't use the indicator, you're going to use the outputs of the indicators. You're just going to do some kind of a replacement. So you need to be aware of the key outputs of the indicators, like the momentum output, the sine waves outputs, the trend channels, the context channels, all of these things. You should still be able to use the words so you can communicate with each and every user into the Discord, ask questions. The strategy itself relies on the same use of words. Okay, so we're always going to use those words, the trend channels, the context channels, and so on. And if you're not using the indicator, I still suggest you use these words. Okay, so you can communicate and spread and share with other users into the Discord just like any other regular user. You're just not using the indicator, and instead you're going to use manually plotted stuff that will act as replicates of these indicators outputs. Okay, so basically what we do is we're going to take kind of a table with two columns and multiple rows, in which we're going to have left row would be the defined indicator outputs, and on the right row we're going to create a set by set of stuff that will replace each and every one of these outputs. Okay, and you're going to have to be able to familiarly to natively be able to switch between the two. Like when the strategy tells you to look at the trend channel, you know how to translate that into the thing that you need to be doing manually to get the answer to your questions. Okay, if you need the trend channel support, then you know that this means, okay, I need to contextualize. Do I need to use this tool or this one? I draw the tool, and here is my trend channel support. Okay, so this is what we're going to be doing. Okay, and I'll explain everything about what necessarily has to be done in order to achieve similar results without the indicators. Okay, so that's the thing. Okay, just a few tools will be able to replace. It's not going to be the exact same outputs, it just can't be the case, but it's generally going to be similar enough that you'll be able to trade the strategy even with the guys out there who use the strategy with the automated tools and have somehow similar results. Okay, always remember that you trade what you see in front of you. So if you use the strategy without the indicators, even if someone has the indicators and has a slightly different level than the one you have, trade what you have in front of you. Okay, what matters is consistency over using the key rules of the strategy. Okay, the magic isn't the indicators. The indicators are just meant to help using the strategy. The strategy itself is the magic, and you just can't cheat. You can't change the rules, you can't adapt, you must follow the guidelines, period. All right, so now let's dive right into the big deal itself. So we're going to take each and every one of the outputs that we have available out there, and we're going to replace them with equivalents that do the job quite well. Okay, so as a moving average, in here we are generally using a 20-period moving average, but it's anchored to the context time frame, which is, this is the time grid we're using, I'm using with the strategy, okay? Which means if you are 2 time frames above in the grid, meaning this is a 20-day moving average. So you've got multiple options. Either you manually put it that way, and you're going to say, I'm on an H1 chart, so I'm going to use a 20-period moving average, but I'm going to synchronize it to the daily chart. Okay, this is something you can do, and you're going to get the exact same output as we have on the indicator side. That's one way to do it. Or you want to make it kind of automatically plotted, so you don't want, and in that perspective you can use something like a 200 moving average. This is definitely not the same output in our current case, but this is somehow doing quite of a not so bad job. Okay, so if you want to go for 250, whatever, okay? This is really not the most important stuff. The moving average is just going to help you do what we do when we contextualize the market. What are the price doing according to their historical prices? Are we above, below the moving average, and so on? This is what's going to define what you're going to do in terms of indicator plotting, okay? Because the first things you're going to need is to plot the context, because that's the first thing we look at when we try to contextualize our market. And this is what you're going to have to do as well, all right? So the first thing you do is that you're going to position prices toward the moving average. Prices are below a falling moving average. So in that perspective, you rather like to use trend channels, okay? And you're going to have to figure out what the prices have done. So when the prices go down, you're going to have to pick the latest 2 bottoms. Okay, pick significant bottoms level. We will use some other tools later on to help formalize this decision-making process, so you remove any potential personal assessment. Otherwise, let's do it that way, okay? So we take the latest 2 bottoms to build a trend channel, and we're going to take that as of the intermediate resistance. The resistance you take as a reference must be in between the 2 bottoms, okay? Not this one, because it's before, it's after. It only has to be this one, okay? So it's not necessarily the highest high point, because in that perspective, sorry, I'm going to use this one instead. Okay, this is the 2 bottom reference. I could use this, which is the intermediate market top in between, but this is not what I use. I take the level that integrates the largest things, okay? So this would be this one. This is the largest trend channel I could get, okay? Are we all agreed with that? I take the 2 reference bottoms to the in-between largest trend channel I could build with anything and any price I have available in between. I can't take anything outside of it. Not this market top, not this one, just the largest possible trend channel with in-between prices. All right, okay? So now, of course, you would say, well, eventually I could have considered this bottom, or I would agree with that, but these things have to be formalized, okay? So the best way you can do this is, if you want to look for the 2 latest anchor points, you can use this sine wave analysis tool, okay? The sine wave analysis tool has to be manually crafted to the levels that suits you the most, but the key rule in here is, once you found a suitable setting, if you change, it is the worst thing to ever do. Take a setting and don't change anything, okay? So if you want something fast and crisp, go for it. If you want something smooth and slow, go for some larger levels. But what matters is, once you settle for something, you never changed anymore. Okay, sometimes it will be better to have a smooth things, and you will lack of detail on some more crisp and sharp analysis. Looking for perfection is by far the stupidest thing to do in trading, okay? Averaging stuff is the cost of externalizing decision-making processes. Using indicators, whether they are manually crafted by me or generally available into public platforms, and I'll tell you about this indicator, it still means you're externalizing the decision-making processes to tools. And these tools introduce noise because they can't be perfect, but this is always by far going to be better than doing it yourself. Because doing it yourself means someday you'll be more aggressive, the other day you'll be less aggressive. You vary because you're a goddamn human being. And variance is what we want to avoid in the strategy process. All right? So the way you can use this thing is an automatic free tool, which is this one, okay? You look for new indicators, you look for sine wave as a research, and you should find this one, which is the Madrid sine wave, okay? It is not that bad. I could have searched deeper, okay? So you can definitely use another cyclical indicator, but that's by far what I recommend to be the best at at automatically defining where you need to plot market tops and bottoms, okay? So what matters is if you fail to manually and with confidence to put, damn it, the available range boundary, oh fuck it, sorry, Jesus, okay. If you can't make it manually with enough confidence, then don't vary. Use an outside source to decide for you. It's not going to be perfect, but if you change it, it's not going to work, okay? Don't change. Find something, fine-tune it for a few days eventually, and then settle for it forever. All right. So if you want to use this thing, the way I would recommend it to do is you avoid tiny cycles like that to be counted properly, okay? You just wait for the indicator to do kind of a bottom, okay? You wait for the indicator to switch in the opposite direction to confirm that a bottom has been made, okay? So currently we're going down, okay? So we need to wait for the indicator to go up to confirm a bottom, okay? That's what we need, okay? And if it lasts for just a few bars and then regains strength to the downside, then you consider it has been a false signal, okay? And you keep looking for bottom areas in that perspective. Are we agreed? What that looks like is that basically in here, if we consider this one to be a false flag, okay, means that we are in a down cycle till then. The latest bull cycle is this one. The latest bear cycle is this one. Whether you actively consider this one true or not, I would say it's okay. That means another bottom is here. And if you consider this one unavailable, then there is a single downside leg in here. Quite a bullish cycle here. And here you had the latest drop. Okay, so considering it that way, it's an oscillation. Okay, so in that perspective, that gives you this, and this. And this gives you these cycles. And then you pick the lowest low to the highest high, to the lowest low, to the highest high, and that gives you the anchor points for your trend channels. All right? Are we all agreed with that? At that point, shouldn't be any shadow or shaded gray areas. Everything has to be defined by an indicator to tell you what to do. So there is no personal assumptions or whatever. It's not going to be perfect. Sometimes it won't be giving you the best information you could have got, but it's far better than assessing it manually if you don't know how to use it. Okay? So go for this. I think this is good enough. Define a set of rules that you will follow every fucking time. Fine-tune the settings to something that looks good enough for you. Okay, backtest it for a few days, use some replay, and once you think it's good enough, it's always better than personal assumption. And go with it. Perfection seeking is the worst thing to do. All right. I'm not going to say it over and over again. Now, the next process is that you understand that what matters for us is when prices go into these tradable areas, okay, our contexts, and how they behave out there. So when the market is trending, okay, or moving in any direction, okay, what matters is that this will be your speculative area. Okay, how do I get this gray thing? Pay attention to this. I'm going to give you the settings. It is something you're going to have to copy. When this is the color, means that the opacity has been set to 0. Okay. So that means this is the only way you can get these gray areas. Okay. You're going to have to use some shades in here, and the rest of it has to be full opacity. Okay. Just copy the same settings in here. All right, that is going to be for the trend channel. Of course, the 50% context is going to be the equivalent of this line, which is the 50% line. All right? So the 50% line is you never buy above, you never sell below. Okay, same strategy rules, you just use different manually plotted tools to get to the conclusion. All right. So now that we have built our trend channel, okay, the market in here is going down. So what we're going to do in here instead is to use this market top and this market top as a reference. Markets going down means we need to take the latest two resistances to build a trend channel. Okay, so let's do it that way. This resistance to this resistance, and we try to take the broadest possible trend channel. This would be this, okay? So this is our trend channel. Problem is we severely broke below. So this is how you're going to have to manually adjust, because what we're going to use to define our context can't be just the trend channel. Otherwise that would be too easy. I've worked goddamn hard to get these goddamn channels. So this would be way too easy if you just had a trend channel to plot. So when the trend channel is severely broken, okay, when prices have installed away from the trend channel, you lost about what? Try to be just a bit more specific. Oh, okay, it's just sound. Oh, all right. Normally it should be fine. I think it's a problem on your end. Okay, sorry about that. So here's your trend channel. You severely broke below, so you're gonna have to find something else. The best I found is that you're going to alternate between trend channels, and when the trend channel is broken, you're gonna use something different. You're gonna remove this trend channel, and instead you're going to use pitchforks. You're going to use the same anchor points, okay? As markets are going down, you're going to use the latest down points, okay? And in that perspective, this is how you will get your third range boundary. Okay? So this one is an inside pitchfork. Okay? Are we good with this? You can use original pitchforks as well, and you alternate between these two. Okay, only original and inside. You don't use the shift, the shifts and so on. Okay. And you try to find something that can work. So right now you would be inside the resistant context. But like I said, it works like a channel, so you can't have prices outside. So work this thing out so you get everything included. Okay? You work it however you want, but I want every prices included in the channel. So this would be your price levels. All right? This would be your channel. So of course, if prices get inside the channel, you need to get minimum 61% retracement, all of the stuff you know, okay, use the fibs and so on. Fibs can easily be manually plotted. Are we all agreed with that? Okay. So now that you know what you need to oscillate with, okay, you've got three choices. The first one is a trend channel. It generally acts when trends are behaving. When you break the trend channel, I'm not saying just dip in below, I'm just saying breaking below it, you're going to use the pitchforks. Generally, this is going to be the inside pitchfork. Okay? This is the one that's going to give you the third range boundary. That's the closest thing you'll find of a third range boundary. And then, if you break out of this third range boundary, you're going to use the alternate third option, which is the original pitchfork. Make sure you always take the broadest prices, and this would be your next target if you break the resistance level in here. Okay? So you oscillate between the three to find the one that suits the current context. When one is failing, go for the next one in the line. Okay? Is this okay? If it's not, you let me know. You have three options: trend channel, then inside pitchfork, and finally the original pitchfork. And normally, if you get out of the original pitchfork, means you need to build another trend channel again, and so on. Okay, you have three options. Find the one that gives you the next tradable area. All right. Of course, regarding the intermediate one, okay, the inside pitchfork, let's build it again. Okay. So this one was built out of this level and this as an inside level. All right. So remember that you are in third range boundary context allowed to trade above. So in here, you don't switch to this one just because you broke out of this one. Okay, remember that the prices can stand on top of the resistant context for a little while. Okay, so before switching to this one, you really want to go making new all-time highs. Okay, so as long as you do not make all-time highs, you trade above the resistant context, but you still have, out of the 76% fib cluster, a technical resistance level. Okay? Remember that in ranges, dynamic level can be tricky, and time can be a bitch in ranges. So anyhow and anyway, the strategy includes a Fibonacci filtering option that you're gonna have to use as well. Okay? So inside the fibs, we need to get there, minimum 61. Okay, oh, inside the context, sorry, and above the context, here is your speculative area, above 76% fibs. Are we agreed on that? And this replicates the rules that anyhow and anyway you would follow as well with the core strategy with automatically plotted indicators. Same thing, same rules, just translating the language into manually plotted indicators. And you'll get to the same conclusions like 90% of the time. And if you ever get to a different conclusions than someone using the indicators, use what you have in front of you. You rather like to be wrong with consistency than being right by switching and tweaking stuff. Are we okay on contextualizing? Okay? To contextualize your market, if you broke out of your trend channel, means you're in a range. Okay? If you are still trading below the inside pitchfork, means you're in a fucking neutral range. Okay? If you're trading above, if you are still below, you are in a range. If you're trading above, then you are at best in a neutral range. Worst case scenario, you're going to go back to trend. But there's something you forgot. Remember that the strategy sometimes talks about multi-time frame assessment, because when you're in a range, you want to make sure that you're not into a higher time frame range. Okay? So always make sure to do the job to find out the appropriate context between trend channel, inside pitchfork, and eventually normal pitchfork, okay? Original pitchfork, and do this by doing it again on the higher time frame. Okay, same exercise out there. We've made it for the trend channel, and we're currently dealing with this, and that would be the equivalent of our strategies trend channel now. Let's do the context. Okay, we would be in a downside move. The higher move is in here, downside up. Okay, so we've got our market top into this area. Okay, we would eventually consider all of this. This would be a false signal to me. So this whole thing is the latest market upcycle. This is the other one. So we've got these two clusters to find our two upside anchor points. Okay, find the largest one to the in-between level. This would be our trend channel. So what is our market context in here? The higher time frame is still trending, and we are currently ranging on the trend channel. Quite simple, right? Okay? Are we all okay with this? It's a range inside something that, as of right now, still could be a trend. range inside the trend. So either the trend is terminating and will reverse, and in that perspective we will fuck up this trend channel as well, or this is still a trend and we'll go right back up to all-time highs. The decision cluster is pretty much nearby now. There is an other intermediate risk cluster that surrounds the 76% fib. So we're nearing the first one, but has to go to 43.25 to get you minimum risk limitation. Okay? But if the market ever reverses inside this context and go right back down to the support will likely break. Okay? But in order to trade it, you need to have at least 61%. Otherwise, if we trade successfully above this resistance context, 76% is the next tradable area for a neutral range, and then prices will stabilize below this level but above this one, waiting for further direction. Either we finally end up breaking the goddamn trend channel on the higher time frame, or reactivate. And you got the whole fucking plan without any of my automated tools. You'll get to the same conclusions I will get with my indicators with manually plotted indicators. But you have to do it well. You have to follow a path. You have to set some lines and rules that you will always follow. All right, now, then next, there is still something that we need to figure out, which is the momentum indicator part, okay? Because momentum or my signal indicator part uses two things. I'm using a sine wave, a cyclical reading. You can use this generic sine wave as an assumption for this, okay? But it will be far less precise than mine are. So you can forget about cycles, or you can set a different cycle indicator, which I think would be too much. But you're desperately going to need a momentum signaling indicator. You just don't trade into an area without an external signal. That must come from something else, okay? So it can't be just a candlestick pattern or whatever. Take something that comes out of a different area, okay? So this is where you define tradable areas. This would be your signal indicator. I don't know what you can use. Go for RSI. Zero lag MACD can work. TSI, the true strength index. All of these momentum derived indicators work just fine. It's going to be your own job to find some patterns, okay? The equivalent of mines. My strategy sets different outputs for trending signals and ranging signal, okay? And that's the only thing I'm going to require. 2 lines for trending signals and ranging signals. The one I have in color and the one I have without color, okay? I don't need you to have more advanced stuff like the squeeze, whatever. These things can be useful, but don't necessarily make a huge difference in the beginning. What matters to you at best in the beginning is to really transfer all of the core basics of the strategy into your manually plotted stuff, okay? It's really important that you be able to switch all of the names that I use with the strategy into the things that you're going to have to look for in your local timeframes. All right? It really is important that way, but each and every one of the rules I teach you normally should work just fine or quite similarly with the manually plotted tools. Alright, if you guys have no questions, I'm pretty much finished with this. Okay, so find a suitable momentum indicator. Regarding the contextualization, you have your 3 sets of tools and you rotate between them. To find the anchor points, I recommend you to use this thing, which is the Madrid sign.